Somewhere right now, a family is about to receive a check for $1 million. Not from a lottery, not from an inheritance, from a piece of paper someone signed years ago. A piece of paper that cost less than their monthly phone bill. That piece of paper is a life insurance policy. Today, we're walking through exactly what happens when someone buys a $1 million life insurance policy, what it actually does, what it costs, and what most people never think to ask before they sign. This video is for general education only, not financial or insurance advice. Let's start with a simple story. This is a fictional example just to make things easier to follow. Call him Daniel. Mid-30s, married, 2 kids, a mortgage, a car payment, and a job he's good at but that isn't guaranteed forever. Daniel doesn't have $1 million saved, but he wants his family to have that kind of security if something happened to him unexpectedly. So Daniel buys a life insurance policy with a $1 million payout. Here's the part most people don't realize. Daniel isn't buying $1 million sitting somewhere with his name on it. He's buying a promise, a legally binding contract that says his family will receive $1 million if he passes away while that contract is active. That's the whole product. It's not a bank account. It's not an investment account. It's a transfer of risk. Daniel pays a small amount regularly, so a much larger financial risk doesn't fall entirely on his family. And the price of that promise is small compared to the payout. A policy like this might cost a healthy person somewhere in the range of $30 to $60 a month. That gap, a small monthly amount buying a payout of $1 million, is the whole reason this kind of insurance exists. Understanding why that gap works is where this gets interesting. Insurance isn't guesswork. It's one of the most data-driven financial products that exists. Every policy is priced using statistical data on how likely people are to pass away at different ages based on health and lifestyle factors. Specialists spend their careers calculating these odds down to fine detail. Here's the mechanism in plain terms. Thousands of people buy policies like Daniel's. Statistically, most people paying into this kind of policy will outlive the coverage period. The money collected from everyone who doesn't pass away during that time helps cover the payouts for the smaller number who do. This is called risk pooling, and it's the basic idea behind most insurance: health, auto, home. Spread risk across a large group, and a rare, costly event becomes affordable for everyone because everyone contributes a small amount. The money collected is also invested conservatively while it sits, generating modest returns over time. Between the statistical pricing and the investment growth, a small monthly payment can responsibly support a very large payout. It's not a trick. It's math applied at scale. Once you see it, the whole idea makes a lot more sense. So what actually happens the day someone applies for a policy like this? Step 1. The application. Detailed paperwork, health history, family medical history, occupation and lifestyle habits like smoking or higher risk activities. Step 2. A health check. For a policy at this size, a short medical exam is common. Basic measurements are taken. Blood pressure, height, weight, and a small blood and urine sample is collected. Step 3. Review. The samples are checked for general health markers. This step helps confirm the information provided in the application. Step 4. A rate is set. Based on everything gathered, an applicant is placed into a pricing category. Someone in excellent health typically qualifies for the lowest monthly cost. Someone with certain health factors may pay more for the same payout amount. Step 5. The offer. A formal offer comes back with the monthly cost locked in for a set number of years, commonly 10, 20, or 30. This process usually takes a few weeks from start to finish. One detail worth knowing: coverage typically doesn't begin until the policy is officially approved and the first payment is made, so it's worth asking directly about coverage timing during the application process. There are 2 broad categories of coverage worth understanding. The first type covers a set period of time, say 20 years. If the person outlives that period, the coverage simply ends. There's no payout and no refund. It's pure protection during the years it's needed most, which is exactly why it tends to be the lower cost option. The second type is designed to last a lifetime rather than a set period. Part of each payment goes into a savings-like component that can grow over time within the policy. The trade-off: for the same $1 million payout, this second type typically costs several times more per month than the first type. Why would someone choose the more expensive option? Because it isn't just about a payout after death. It can also function as a long-term savings and planning tool. The savings component can sometimes be accessed while the person is alive. And because the coverage doesn't expire after a set number of years, some people use it specifically to make sure loved ones have accessible cash right away, even if most of their wealth is tied up in property, a business, or other assets that take time to sell. For most everyday families, though, the first type, coverage for a set period, is the more common choice, because it provides strong protection during the years it matters most, like while raising children or paying off a home, at a much lower monthly cost. Let's walk through the moment this entire contract exists for. When the policyholder passes away, the people named on the policy file a claim, submitting an official death certificate along with a simple claim form. The claim is then reviewed. If the policy has been active for more than a couple of years and nothing about the death falls under a specific exclusion in the contract, the payout is typically processed within a matter of weeks. That early period, usually the first 2 years a policy is active, matters. If someone passes away during that window, the details of the original application are reviewed more closely. If something important was left out or misrepresented, the payout can be adjusted, or in serious cases, denied. This is part of why the application process asks such detailed questions up front. It protects the fairness of the system for everyone paying into it. Once approved, the payout is typically sent as a single lump sum directly to the people named on the policy, rather than through the general estate process. This detail matters because money paid directly to a named person usually becomes available much faster than money that has to move through a longer estate settlement process. One more detail worth knowing. In most cases, this kind of payout is not considered taxable income for the person receiving it. There are some exceptions depending on the specifics of a situation, but generally, the full amount arrives without being reduced by income tax. So, how does this whole system stay sustainable? It comes down to the same principle from Section 2. A large group of people paying small, regular amounts, so that the rare, high-cost event is manageable when it happens. The money collected across everyone helps fund the payouts for the smaller number of families who need them. It's a system built entirely on shared risk and statistics, not luck and not guesswork. That's also why it's worth comparing a few different options before choosing a policy, since pricing and terms can vary based on someone's individual health and circumstances. Taking time to understand the terms of any contract before signing is always a reasonable step for insurance or any other financial decision. So, back to Daniel. He pays a modest amount every month for 20 years. Over that time, he'll pay a total that's a small fraction of the payout amount. If he never needs it, if he lives a long, healthy life and the coverage period simply ends, that money doesn't come back. That's not a loss. That's the cost of 20 years of certainty for his family. But if the unexpected happens, his family receives the full payout, generally within weeks, without it being counted as taxable income and without a long wait through a formal estate process. That's the entire idea. Not a lottery ticket, not a traditional investment, a contract built on decades of statistics that turns an uncertain future into a guaranteed outcome for the people left behind. If this helped explain something you've been curious about, let me know in the comments what financial topic you'd like explained next. This video is for general educational purposes only and is not financial, legal, or insurance advice. Terms, costs, and eligibility vary by individual and provider. Consult a licensed professional for guidance specific to your situation.